So this is my first video. I'm going to explain the wheel strategy, hopefully in like 3 minutes. So I'm assuming that you are comfortable selling options. If you're not, then go find one of the many entertaining and well-made videos that explain how to trade the options wheel. Here's my short summary. So first step is to get some cash in your account. I think 25,000 is a good number. It allows you to trade the wheel on several underlying securities that have a reasonable stock price. Second step is to actually choose an underlying. I'll explain more on my selection process later. Step 3 is to start selling cash secured puts against the underlying. So you have to have enough cash in your account to actually purchase 100 shares of the underlying when they're assigned, and that's step 4. So if the stock price falls below the strike of that put, you have to buy the shares at that strike price. Step 5 is to start selling covered calls against the underlying. And again, now when the call is assigned, when the stock price rises above the strike price of the call, you'll be forced to sell your shares at the strike price. And you have cash in your account, you can go back to step 3. So here's my thought process on how to choose underlying security for the options wheel. First, you have to choose underlyings that have a low enough stock price. So for instance, SPY is close to $400 per share at the time that I record this video. So in a $25,000 account, I can't even own 100 shares. I'm typically looking for shares that are between $15 and $50 per share. A very low share price may create some problems for options trading. The strikes, if the strike separation is at $1 on a $4 share price, then it's kind of problematic to trade options. It may also indicate that the company is distressed. So my next criterion is liquidity. And what do I mean by liquidity? First, I only want to deal with large companies, typically market cap greater than $1 billion. Second, the options need to be actively traded. If you go to the options chain and look at the trading volume of an at-the-money put or call, then I would expect to see at least 10 contracts traded per day and preferably more than 100. This is nothing compared to SPY, which might have 10,000 contracts traded per day. The next liquidity criterion is the increment of the option strikes. So for instance, if you have a $50 stock, but the strikes are spaced $5 apart, and that's a bad choice for the wheel. For a stock price that's $50, I want to see $1 between the strikes, and even better if there's only 50 cents between the strikes. Personally, I trade weekly options because I want to take advantage of the steepest time decay, or theta decay, of the options, and that occurs in the last 5 to 10 days of the option. A very important criterion for the wheel is to collect good premiums when you sell options. And what do I mean by good? I want to collect more than 1% premium when I sell a 30 delta weekly option. Like for instance, if the share price is $25, then I want to sell weekly puts or calls for more than 25 cents. Next, I try to avoid distressed stocks. I may seek out an unpopular industry sector, like the oil and gas industry, but I want to pick reasonably healthy companies. The last point is very important. You do not want to have active options contracts at the ex-dividend date or at the earnings date. Also, if you want to collect that dividend, then you need to own the shares before the dividend date. You can, if you don't own the shares, then you can own the shares more than likely by selling cash secured puts with a very aggressive strike. I typically sell 30 delta options, but I might sell a 50 delta option, or even in the money put, in order to have a higher likelihood of being assigned the shares before the dividend date. Okay, so when I trade the wheel, I typically only sell 30 delta weekly options. I typically buy back the option when the price drops to 1/3 of the premium that I originally got. So for instance, if I sold an option for 30 cents, then when the price of that option fell below 10 cents, I would buy it back. you can easily set a limit order to buy back these options. And I really like this approach because I often buy back the option automatically during a short-term spike or drop in the stock price. And by the time I get around to selling my next option, that short-term spike or drop may have reversed. So this is kind of a nice way to scalp the exits from your option positions. When I buy back an option and there's 3 days or more before expiration, I will sell a new option with the same expiration. So in other words, if I'm trading weeklies and the expiration is on Friday, if I get a sign on a Monday, then I will buy back the option. I'm sorry, if I buy back the option on a Monday, then I will sell another option with that same Friday expiration. However, if I'm less than 3 days from expiration, I will sell my next option in the following weekly expiration. And again, as I stated before, and I learned this the hard way, I make sure not to have any open options contract on the ex-dividend date or the earnings date. So in the next videos, I'll review some of the performances of various underlines that I've traded, and that'll be more interesting. Thanks.